Strategic Dream. Trading Psychology in Depth. What is trading psychology? Trading psychology refers to the emotions and mental state that help to dictate success or failure in trading securities. Trading psychology represents various aspects of an individual's character or behaviors that influence their trading actions. Trading psychology can be as important as other attributes such as knowledge, experience, and skill in determining trading success. Discipline and risk taking are two of the most critical aspects of trading psychology, since a trader's implementations of these aspects is critical to the success of his or her trading plan. While fear and greed are two most commonly known emotions associated with trading psychology, other emotions that drive trading behaviors are hope and regret. Breaking down trading psychology. Trading psychology can be associated with a few specific emotions and behaviors that are often catalysts for market trading. For an understanding of these qualities, consider some of the leading examples. Greed is an excessive desire for wealth. It often causes traders to stay in profitable trades longer than it's advisable in an effort to squeeze out extra profits from it, or to take on large speculative positions. Greed is an apparent to show in the final phase of a bull run market, when speculation runs rampant and investors throw caution to the wind. Conversely, fear causes traders to close out positions prematurely or to refrain from taking on risks because of concerns about large losses. Fear is probable during the bear markets, and it is a potent emotion that can cause traders and investors to act irrationally in their haste to exit the market. Fear often morphs into panic, which generally causes significant sellouts in the market from panic selling. Regret may cause a trader to get into a trade after initially missing out on it because the market moved too fast. This is a violation of trading discipline, and it often results in direct losses from security prices that are falling from peak high. Avoid analysis paralysis. Most traders start out soaking up information. This information will come in the form of currencies, picks, books, seminars, trading coaches, gurus, you name it. Your personal beliefs, backgrounds, and personality traits will then take that information and digest it into what I call your foundation for trading. Net, you will take this newly information into the world of the market. This can be exciting and a bit scary at the time. If you are lucky, you will put on a few trades and things will go smoothly. The money will just flow. Trading psychology. If you are unlucky, you will quickly realize why 90% of traders fail within the first few years of taking up the charge. No matter how you start out, your inability will face a loss that will put on a bad position and hit you in the gut. This loss will resemble the first time you had your heart broken, or the disbelief you had when you heard at school that Santa didn't exist after your parents have been helping you draft your Christmas wish list and leaving out cookies for years. You will feel a sense of utter disparity as your trading world unravels much quicker than the time you have spent to build it up. This is the phase where most traders will spend their entire careers. In any business analysis of the company's performance to drive further growth in paramount, trading is no different. The only problem is you have to decipher when it's time to tweak your model versus when results are just noise from the markets. Think about it. If you have just spent hours, weeks, or months researching a system, the system on a front looks like it will give you an edge over the market, let's say 60% of the time. In addition to this edge, it also provides 2 to 1 in terms of the size of winners and losers. By all accounts, this will be considered a system testing in the real world. Of course, since the market is random, let's say out of your first 6 trades, only one works. The seasoned trader will know that it is a matter of placing a large enough sample set of trades for things to net out. The junior trader or the trader stuck in the analysis paralysis phase will without a doubt change this system before it has time to bloom. As it sounds so obvious that you must allow time and opportunity to work in your favor, but when it's your hard-earned money on the line, your first reaction is to analyze and correct. It's such a normal human reaction to protect oneself. Yet this type of behavior is what traps us as traders and never allows us to reach our full potential. Allow that market is random. Understanding that market is random is probably the key tenet of becoming profitable. I have done it all in terms of predicting the next action of the market. Elliott wave, harmonic trading, point and figure, classic breakout estimates, etc. At times, the market will adhere to your analysis, which would make me feel like I was in control of the situation. However, there were times when the market will pass through the key levels as it didn't exist. I've realized that the overall analysis does not exist anywhere else but in your head. The only reason the market will respond to the analysis is based on whatever or not the other active trader who can influence the move or the price are on the same page as I. It only takes one trader with enough capital to completely invalidate your analysis. It doesn't take a herd of people yelling and screaming on the floor or placing thousands of trades. Review your equity curve. People spend a lot of time analyzing their individuals, winners, and losing trades, looking for some sort of insight that will help them crack the code. Maybe if I choose a different moving average or if I cut losses early, these are all helpful things when looking at one or two trades. But how would this impact all your trades? Have you honestly maintained the same system long enough to take the analysis? How minor tweaks would help? Truly accept the risk. Some of you reading this will say that you always place your stops and are willing to lose the money. While you may say this, you really didn't want to lose the money. You'll place a stop out there which could be pretty far off from your entry price. Over the next couple of hours or days, depending on your time frames, you will slowly move the stop up because at some point your new stop order is triggered. Right before the market takes off, if this has happened to you, it's one of the most frustrating events that can occur in the market. Your analysis was right. The market in the end gave you what you expected. However, you were not willing to accept the randomness of the market and the fact that you could lose money. Until you accept the risk, you will interpret the noise of the market as potential threat and will find some way of rationalizing to yourself that you must exit the trade now. Recognize when you are wrong. Recognizing when you are wrong does not mean the price deviates from how your analysis stated things should go. Remember, the market is completely random. Understanding when you are wrong is something you need to define. For me, it's how much position goes against me before I see profit. Once this happens, things will go one or two ways for me. First, the market will give me the mercy exit opportunity and will close the positions with a minor loss or slight gain. Secondly, the market will continue in the opposite direction and I will step back. Please do not get caught up in the specific rules. More focus on the fact that you need to know when you are wrong. Accepting that you will not always get in the right will save you a lot of sorts of time and money. Trading psychology and self-reflection. Never be too proud that you are unwilling to paint out your flaws. If you approach the market from a negative perspective, you will lose money. Negative does not mean you expect to lose, but you may have a lot of fear in your trading or have fully. Trading psychology and self-reflection. Never be too proud that you are unwilling to paint out your flaws. If you approach the market from a negative perspective, you will lose money. Negative does not mean you expect to lose, but you may have a lot of fear in your trading or have not fully accepted the risk. Reviewing your equity curve and keeping a trading journal will help you navigate times when you fall off the rails. Develop a winning attitude. When you are in the zone, it is the best feeling in the world. It's like you and the markets are 100% connected in a constant flow of abundance. You can only get this mental place if you approach the market with a I am right attitude, but you fully accept that you will get whatever the market is willing to provide. In summary, winning at trading has little to do with your system, trading equipment, or internet speed. It comes down, can you accept full responsibility for your trading results? Do you accept the fact that the market gives you what you are willing to receive? Do you believe in the concept of probabilities and that you do not have to be right on every trade? The quest of finding the trading zone and staying in it never ends, so remember to have fun along the way. Turning your dream into a strategic dream. Dream big. Peace.